Good day, ladies and gents, fellow traders. Welcome to Precious Times with Alex Morrison, where we are all about value and commodities. Talking about value, how do you value oil? It's likely you use one of the industry's pricing benchmarks like Brent or WTI. So let's see how the key benchmark prices are put together.
The many types of crude oil and the different sites from which it's extracted means buyers need an easy way to value the commodity based on quality and location. There are dozens of oil benchmarks, but price is most often pegged to one of three. About 2/3 of all global crude contracts reference Brent blend. Brent refers to oil from 4 fields in the North Sea. Its crude is light and sweet, ideal for the refining of diesel fuel, gas, and other high-demand products. And since it's waterborne, it's easy to transport long distances. West Texas Intermediate, or WTI, refers to oil extracted from U.S. wells and sent via pipeline to Cushing, Oklahoma. Being landlocked, WTI is more expensive to ship around the globe. It's light and sweet, ideal for gasoline, and the main benchmark for U.S. oil. Dubai Oman is a Middle Eastern crude, slightly lower grade than WTI or Brent. Coming from Dubai, Oman, or Abu Dhabi, it has heavier sulfur content, making it more sour. It's the main reference for Persian Gulf oil delivered to the Asian market. Buyers use crude oil futures to lock in prices for months or years and minimize the risk of sudden increases. Those contracts are tied to oil benchmarks. Brent contracts trade on exchanges such as ICE Futures Europe, while WTI contracts are mainly sold on the New York Mercantile Exchange.
It's important to realize one crucial point when trading oil. The price you are looking at in the media or in an exchange is based on future expected values. Oil traders buy futures to lock in prices at advantageous levels. There are different types of oil traders. There are traders who are actually going to receive the physical oil. These might be distributors, electricity suppliers, or even fuel suppliers. And there are traders who are using an oil futures contract as a financial instrument, like hedge funds, investment banks, or individual traders themselves. If the trader is going to receive real oil, they want to keep a stable price. Financial oil traders have a different motivation. They don't care about receiving the actual barrels themselves. That's not why they buy the contract. Can you picture in their faces if 100 barrels of oil showed up in the bank's reception area? No, these types of traders have no use for physical oil. Instead, they want to make a profit on trading the price of an underlying futures contract. The oil markets are incredibly efficient. They move extremely fast and there is frequent volatility. The second there is a political problem in an oil supplying country, traders react with fear. What if the supply is affected and reduced, they ask themselves. Physical oil traders, on the other hand, are most worried about not receiving their supplies at the price they locked in. They're twice as concerned that the price will go up if supplies are indeed threatened. Financial oil traders will be more concerned about price direction. Their fear or optimism will depend on whether their trading strategy is short or long. The price can often rise rapidly on market fears. So you need a strong stomach. The 10-year WTI crude oil benchmark charts look like the Himalayan mountain range. The peaks and valleys in the price were dramatic. The last 10 years were possibly the most volatile in the tracking history of crude oil benchmarks, comparable only to the 1970s and the Iran-US oil crisis. WTI is traded on the New York Mercantile Exchange. It is the lightest, sweetest crude oil on the markets and comes directly from the U.S. domestic suppliers. Crude oil is described as sweet when it has a low sulfur content. At the start of the financial crisis in 2008, WTI took a huge cliff dive. By the end of the year, it dropped from $147 a barrel to just under $32. The markets were shocked. Just imagine electricity plants all over the world had their contracts locked in at much higher prices than the market was willing to pay. Distributors faced falling profit margins, and suppliers watched their cash flow dry up in a matter of days. Earlier that year, WTI hit peak prices, making the cliff drop even more surprising. During the 2008, Time magazine ran a story on SEM Group, an oil distributor from Oklahoma. WTI peaked in the mid-2008, hitting prices of around $147 per barrel. Most market participants expecting the fall to come soon. At that price, SEM Group was holding short positions on $100 million worth of oil. SEM Group didn't own the final delivery yet. They were actually planning on selling them at a lower price, pocketing the expected difference between the peak price and the lower price. Needless to say, unfortunately for SEM Group, the price stayed high for just a few more days, during which NYMEX made the margin call on their contracts. This, of course, forced the company to find more money as collateral to back its short positions. Unfortunately, it was money that they did not have. In that moment in time, they lost over $2.4 billion within a few days and went bankrupt. The same exact pattern of losses was seen across the board. Companies holding long positions were surprised by the extent of the drop in prices. Liquidation and more liquidation was the exact reaction from all the investors. The 2008 oil crash was warning of things to come within the financial commodity markets. Oil market volatility continued. It took 2 years for WTI to rise to the level of $113 a barrel. The price kept fluctuating wildly between 2011 and 2014, ranging from $77 to $103 a barrel, sometimes in a space of just a few days. It was a wild ride. The end of 2014 was really the critical point of the oil markets. WTI started a long decline, finally finding its bottom at around $26.69 a barrel on February 8th of 2016. The wider commodity markets tracked oil's decline, entering a bear market. So the main reason behind the low oil prices was very simple. The global slowdown reduced demand, meaning a supply glut. Oil markets are usually in line with the fundamental laws of supply and demand. Not for the first time, though, suppliers and producers failed to respond quickly enough to the new circumstances. The bears enjoyed good profits as the prices fell. Suppliers kept flooding the markets with stocks which sat in warehouses gathering dust. Short sellers had a field day. It was only in 2017 that OPEC finally committed to supply cuts. These had the effect of supporting, of course, the oil price.
Smiles from Saudi Arabia's oil minister as he arrives in Vienna for what perhaps he already saw as a done deal. OPEC's biggest producer making clear it wanted to extend production cuts from when the current agreement expires in March to the end of next year.
My personal expectation is that 2018 will be more of the same of 2017, which is I think, healthy and manageable by the market.
And even before any new deal was announced, Brent crude prices gained on that sentiment, rising more than 1% to above $64 a barrel, within close range of where most members wanted them.
Around 60 is all the OPEC members and producers are satisfied with the price around 60 for Brent.
Others too see merit in maintaining the status quo. 1.8 million barrels per day of cuts this year has helped halve excess global stocks. Nigeria, exempted from the current deal because of unrest and low output, is now expected to participate, and Libya's inclusion was also under debate. Russia had reservations. While pricier crude suits Saudi plans to float state oil giant Aramco, the world's largest non-OPEC producer needs much lower prices to balance its budget.
There is a real challenge for OPEC insofar as every time the price goes up, the shale players in the United States simply put up the production and drive down the price again, and there is no global agreement on pricing, and therefore the capacity for Saudi and Russia to set the price is quite limited.
A review of the deal could come at the next OPEC meeting in June, in case crude prices begin to overheat.
Short-term rallies were seen during 2018, whilst US President Donald Trump hit Iran with renewed sanctions. Another factor in the rising price trend is Venezuela's internal collapse.
The Iran deal is defective at its core. If we do nothing, we know exactly what will happen. In just a short period of time, the world's leading state sponsor of terror will be on the cusp of acquiring the world's most dangerous weapons. Therefore, I am announcing today that the United States will withdraw from the Iran nuclear deal.
OPEC and Russia aim to rebalance the widely volatile and then depressed oil markets. Its target price was $55 to $65 a barrel, and up to this moment in time, their goal seems to have been reached. What do you think? If you have any questions in regards to what we have discussed in today's episode, feel free to post your thoughts in the comment section. This was Precious Times with Alex Morrison. Till next time.